these basic tools can be very beneficial. A moving average is simply a tool to smooth out some of the ups and downs in the price line, so that it's a bit easier to see the general trend with the naked eye. A simple moving average takes the price of the share over a number of recent days and plots the average price of the share over those days. You end up with a line that looks something like this. This is the 300-day moving average. So for each day plotted on the FTSE 100 price chart, you're also seeing the average price of the FTSE over the previous 300 days. It's what's called a lagging indicator, in that it shows you the price trend, but with a significant lag because it relies on prices from the past. So it's always somewhat behind the action. But you can see how it smooths out most of the chart fluctuations and gives you a more general picture of the ups and downs. Investors often use a moving average like this to decide whether the market is in a bull market or a bear market. For instance, the FTSE 100 started an upward trend in early 2003, which continued until late 2007. The 300-day moving average finally bottoms out in November 2003, and it starts trending upwards. And it tops out in December 2007. So by only buying shares when the moving average is trending upwards, investors can be fairly confident that they're not buying during a bear market. It's a rough and ready tool, but it can help stop investors from making serious mistakes. Most charting apps will allow you to add a moving average to your price chart, and it will also allow you to define the number of days that you'd like it to average over. For long-term investors, 200 and 300 days are pretty popular choices. Some investors try to buy in early to a trend, rather than waiting until it's clearly well established on the chart. That way they hope to buy at a cheaper price. Tends to work like this. A share falls out of favour. Sellers push the price further and further down. Eventually, most of the people who want to sell have finished selling, but not many people are interested in buying yet, so the price bumps along the bottom, sometimes for months or even years. You can tell that not many people are interested because volume goes down. Volume measures the amount of buying and selling going on. These little bars at the bottom of the chart show how lots of selling was going on during the price decline, but once the bottom was reached, it all goes a bit quiet. Most investors lose interest in the stock, and the daily volume bars are small. Typically, the price then moves up and down in what's called a trading range. Every time the price falls to its lowest point, buyers start getting interested, thinking it's bargain buying time. And they buy enough to push the price back up, but every time the price reaches the top of the range, some investors become sellers, keen to take the opportunity to offload their baggage at an elevated price. So to some degree, these range floors and ceilings become self-fulfilling prophecies because short-term traders quickly recognize them as key levels where the price tends to reverse itself. So every time the price reaches the ceiling, it rebounds as sellers sell in anticipation of the price reversing. Likewise, every time the price reaches the floor, buyers buy in anticipation of higher prices to come. So this is why these levels are commonly called support and resistance levels. The price is supported at the bottom of the range by buyers, and the price rise is resisted by sellers at the top of the range. Eventually, something has to give. Either the buyers aren't strong enough to resist the selling pressure and the price bursts downwards through the bottom of the range, or the buyers gain confidence and force the price upwards through the top of the range, causing what's known as a price breakout.